The most financially dangerous earthquake risk in the United States is not California. It is not the Pacific Northwest, where the Cascadia subduction zone gets the documentary coverage and the scientific attention. The most dangerous financial earthquake scenario in the country is buried beneath the farmland and river towns of Missouri, Arkansas, Tennessee, Kentucky, and southern Illinois. And the clearest proof of that statement is not a USGS report, not a geological survey, and not a seismologist's probability model. It is what the insurance industry has quietly been doing for the past several years. Major insurers have pulled back. Premiums where coverage still exists have reached levels that are simply unaffordable for middle-class homeowners in the Mid-South. And an estimated 97 to 99% of the 12 million people living above the new Madrid Seismic Zone have no earthquake insurance coverage at all. When the insurance industry, the business that makes money by calculating and pricing risk, decides a risk is too large to insure affordably, that is not a footnote. That is a signal. Drop a comment right now. Do you live in Missouri, Arkansas, Tennessee, Kentucky, or southern Illinois? Have you ever looked into earthquake insurance for your home and found out what it actually costs? Or that you simply cannot get it? Tell me what you found. If you want to be the first to know every time something like this develops, subscribe. It is completely free. A thumbs up also helps enormously. Let us go for 5,000 likes on this one, so the algorithm puts it in front of the people who need to see it most. Today, we are going to break down exactly why the insurance industry has made this decision, what the new Madrid fault is actually capable of, and what the absence of coverage means for 12 million American households when it goes. No guessing, no dramatizing, just the facts, the science, and the real stakes. Now, let us get into it. The story of earthquake insurance on the new Madrid Seismic Zone does not begin with a geological event. It begins with a business decision, and then another, until a pattern emerged that is now impossible to ignore. In 2023, State Farm announced it would stop accepting new homeowner insurance applications in California, citing the cost of wildfire risk. What got less coverage was the quieter set of decisions happening simultaneously in the Mid-South, where regional and national insurers were reviewing their earthquake exposure in the new Madrid zone and arriving at similar conclusions. Not a headline announcement, not a press release, just policy non-renewals, escalating premiums, and eligibility restrictions that effectively removed earthquake coverage as a practical option for hundreds of thousands of homeowners across Missouri, Arkansas, Tennessee, and Kentucky. A homeowner in Memphis, Tennessee, a city of approximately 650,000 people sitting directly above the southern extension of the new Madrid fault system, who attempts to purchase earthquake insurance today faces one of three outcomes. First, they find a policy, but the annual premium is between $1,200 and $3,000 per year for a home valued at $250,000, with a deductible of 15 to 25% of the home's value. Meaning they would pay $37,500 to $62,500 out of pocket before the insurance pays a single dollar. Second, they find no insurer willing to write a policy in their zip code at all. Third, they find coverage, but the policy excludes damage from fault line proximity, a clause that renders the coverage effectively worthless in the exact scenario it is supposed to address. In all three outcomes, the homeowner ends the process without meaningful financial protection. That changed fast. Between 2022 and 2025, the available market for earthquake insurance in the 5 core New Madrid states contracted significantly. Several specialty insurers that had been writing earthquake policies in the region, smaller carriers and surplus lines, companies that fill coverage gaps that standard insurers won't touch, either raised their rates to levels actuaries describe as technically available but practically unaffordable, or quietly stopped accepting new applications. An insurance broker operating in eastern Arkansas described the situation to regional media in 2024 as, in their words, the most significant market withdrawal they had seen in a 20-year career covering the Mid-South region. The reason is not mysterious to anyone who has looked at the actuarial models. Earthquake insurance is priced on the expected loss from insured events over time. Insurers look at the probability of an event, the intensity of the expected shaking, the vulnerability of the building stock in the area, and the density of insured properties in the exposure zone. When those 4 variables all move in the direction of higher expected loss simultaneously, as they do in the new Madrid zone, the math of affordable pricing breaks down. The new Madrid probability numbers are not negligible. The expected shaking intensity for a repeat of the 1811 events would be severe across an enormous geographic footprint. The building stock in Memphis, St. Louis, and the smaller river towns of the Mid-South is predominantly older, unreinforced construction with minimal seismic design. And the density of people and property in the impact zone is substantial. The insurance market in the new Madrid states has not contracted uniformly. The withdrawal has been sharpest in the areas of highest geological exposure: the river counties of western Tennessee, the Arkansas Delta, the Missouri Buthiel, the Illinois and Kentucky counties nearest the fault trace. Insurers have not announced coordinated market exits the way they announced wildfire-related decisions in California. The New Madrid withdrawal has been quieter, county by county, zip code by zip code, a gradual tightening of underwriting guidelines that, in aggregate, has produced a region where the practical availability of earthquake insurance has become close to zero for the average household. The premium structure that remains is telling. Where earthquake insurance is still technically available in the New Madrid zone, the actuarial math produces premiums that reflect the genuine scale of the risk. A policy on a $300,000 home in a high liquefaction susceptibility zip code in Memphis might carry an annual premium of $2,800 with a 20% deductible, $60,000 out of pocket before coverage begins. For a household earning the Memphis metro area median income of approximately $55,000 per year, that premium represents more than 5% of gross annual income for coverage that, if needed, would still require $60,000 in cash before paying out anything. The actuarial math is honest. The affordability math is brutal. The insurance industry did not design this situation. It discovered it when it ran the numbers. But here is the part of this story that the insurance withdrawal makes impossible to deny. The insurers are not making a philosophical bet. They are making a quantitative calculation. They have modeled the New Madrid Seismic Zone using the same tools that FEMA, the USGS, and university seismology departments use. They have assigned dollar values to the buildings in the impact zone, estimated the damage percentages at different shaking intensities, and computed the expected insured loss from a major New Madrid event. And when they finish that calculation, enough of them have concluded that the risk of a catastrophic loss exceeds the premium they can realistically collect while remaining competitive in the market. That conclusion is the loudest statement the industry has ever made about the New Madrid fault, louder than any earthquake warning system, louder than any government advisory. When companies whose business model is built on risk calculation decide the risk is too large to price at a rate households can pay, the rest of us should be paying attention. To understand exactly why the insurance industry has reached this conclusion, you need to understand what makes the New Madrid Seismic Zone fundamentally different from California, and why the earthquakes it produces travel so much farther and cause so much more widespread damage per unit of magnitude than anything the western United States experiences. The New Madrid Seismic Zone is not a typical fault in the geological sense. It is not a boundary between two active tectonic plates currently in motion against each other the way the San Andreas is in California or the way the Cascadia subduction zone is in the Pacific Northwest. The New Madrid fault system is what geologists call an ancient rift zone, the remnant of a failed continental rift that began tearing North America apart approximately 500 million years ago, stopped before completing the process, and left behind a deeply buried zone of fractured and weakened rock beneath the Mississippi River Valley. That ancient fractured rock is still responding to stresses in the North American plate. It still generates earthquakes. And because it sits in the interior of a thick, cold, rigid continental plate rather than at a boundary between plates, the seismic waves it produces behave in a way that makes them significantly more dangerous at distance. California's geology, for all its seismic activity, is fractured and broken, riddled with faults, basins, and sediment layers that absorb seismic wave energy relatively quickly. The central and eastern United States sits on ancient, cold, rigid Precambrian crystalline rock that has been stable for hundreds of millions of years. Seismic waves traveling through this rock lose energy far more slowly than waves traveling through California's geologically active crust. To put that in context, the 1811-1812 New Madrid earthquake sequence was felt across approximately 1 million square miles of the North American continent. Comparable magnitude earthquakes in California are typically felt across an area roughly 20 times smaller. The 1811 events caused church bells to ring in Boston, Massachusetts. They were noted by Thomas Jefferson in his diary at Monticello, Virginia, nearly 700 miles from the epicenter. They caused pendulum clocks to stop in Washington, D.C. There is no California earthquake in the modern record that has come close to that geographic footprint. There is also the matter of what sits beneath the surface of the New Madrid region that amplifies the danger even further. The Mississippi embayment is a broad, shallow trough extending from the Gulf of Mexico northward through the states of the Mid-South, filled with thousands of feet of soft sediment, sand, silt, and clay deposited by the Mississippi River and its predecessors over tens of millions of years. When seismic waves from a deep earthquake travel upward through bedrock and then enter this thick column of soft sediment, they do not pass through cleanly. They are amplified. In some locations, by a factor of 10 or more compared to the shaking that would occur on bedrock at the same distance from the same earthquake. This amplification effect means that a New Madrid earthquake does not simply shake the immediate area around its epicenter. It shakes a vast region of soft river sediment to a much higher intensity than the raw magnitude number would suggest to someone accustomed to California seismology. The 1811-1812 earthquake sequence involved not one large event, but four. Three principal shocks and a major aftershock sequence, occurring between December of 1811 and February of 1812. The first event, estimated at approximately magnitude 7.7, occurred on December 16, 1811, at approximately 2:15 in the morning. Contemporary accounts describe the ground rolling in visible waves, the ground opening and closing, and a loud rumbling like cannon fire. The second principal event occurred on January 23, 1812, the third, and likely the largest, occurred on February 7, 1812. That third event, estimated by modern seismologists at magnitude 8.0 or greater, produced the most extreme effects. The Mississippi River ran backward in places for several hours. The town of New Madrid itself was largely destroyed, and the ground displacement was so large that it created new lakes, redirected streams, and permanently altered the landscape of the river valley. No other earthquake sequence in the recorded history of North America east of the Rocky Mountains comes close to this in either magnitude or geographic impact. And the 1811-1812 sequence is not an anomaly in the geological record. Paleoseismic evidence from sediment layers and geomorphic features in the New Madrid Zone documents multiple comparable sequences in the past 5,000 years, with recurrence intervals estimated at 300 to 500 years. The sequence is not a single unique event in geological history. It is a recurring pattern. And then there is liquefaction, the fine-grained sediments of the Mississippi embayment. Particularly the sand deposits that underlie much of the Mississippi River floodplain from southern Missouri through Louisiana, are highly susceptible to a phenomenon called liquefaction. Under strong enough shaking, the water pressure in saturated sand deposits can increase until the sand temporarily loses its solid properties and behaves like a liquid. During the 1811-1812 earthquakes, witnesses described the ground opening and spouting water and sand, trees disappearing into the earth, and new lakes forming where land had been. Reelfoot Lake in western Tennessee, still visible on modern maps as a body of water roughly 18 miles long, was formed in this process during the 1811-1812 sequence when the ground liquefied, subsided, and was flooded by the backwater of the Mississippi River. Modern geotechnical surveys of the Memphis metropolitan area have identified extensive zones of high liquefaction susceptibility directly beneath residential neighborhoods, school buildings, and critical infrastructure. Buildings do not stay standing when the ground beneath them becomes a liquid. These are not just geological data points. They are the direct drivers of the actuarial models that are pricing earthquake insurance in the New Madrid Zone out of reach for the average homeowner. California has confronted its earthquake insurance crisis before, and the response it developed stands in direct contrast to the situation facing the 12 million people who live above the New Madrid fault system today. After the January 17, 1994 Northridge earthquake caused over $25 billion in insured losses across the Los Angeles region, the insurance industry in California threatened to stop writing homeowner policies in earthquake-prone areas entirely. The state of California responded by creating the California Earthquake Authority, a publicly managed, privately funded entity established in 1996 specifically to provide earthquake insurance to California homeowners after the private market withdrew. The California Earthquake Authority is funded by insurance company, contributions, and reinsurance, backstopped by the state, and designed to remain solvent even through a catastrophic earthquake scenario. It currently holds more than $17 billion in claim-paying capacity. It is not perfect. Only approximately 13% of California homeowners actually carry earthquake insurance, even with the CEA in place, because the deductibles are still high and the premiums are still significant. But it exists. There is a functional market. There is a public backstop. In Missouri, Arkansas, Tennessee, Kentucky, and Illinois, the 5 states that sit most directly above the New Madrid fault system, no equivalent institution exists. No state has created a publicly backed earthquake insurance pool. No regional authority has been established to fill the gap left by the private market's withdrawal. The legislature of the state of Missouri, the state with perhaps the most exposure in the New Madrid Zone, given that the fault system's northern extension runs directly beneath St. Louis, has periodically discussed earthquake insurance reform, but as of today, no funded solution comparable to the California Earthquake Authority has been enacted. Tennessee, which contains the city of Memphis and the region of highest expected shaking intensity from a New Madrid event, does not have a state earthquake insurance pool. Arkansas, whose river lowlands are among the most liquefaction-vulnerable areas in the country, does not have one. The gap is not a political failure unique to these states. It is a reflection of the enormous financial challenge of creating an insurance backstop for a risk profile as large as New Madrid. But the gap is real, and it is affecting real households right now. A two-family comparison makes the human dimension of this concrete. A homeowner in Northridge, California, a neighborhood that absorbed a direct hit from a magnitude 6.7 earthquake in 1994, can today purchase earthquake insurance through the California Earthquake Authority for a premium that varies by construction type and age, but that is at least technically available at a range of deductible options, including lower deductibles that many homeowners can afford. A homeowner in Memphis, Tennessee, who faces a significantly higher probability of experiencing a major earthquake over a 50-year period than the Northridge homeowner did at the time of the 1994 event, has no equivalent option. They either pay a premium that most households in the Memphis region's income distribution cannot sustain, or they carry no earthquake coverage at all. The difference between those two homeowners is not the magnitude of their geological risk. It is whether their state built a financial institution to manage it. What scientists are monitoring closely in the New Madrid zone right now is not a visible surface fault, but a set of subsurface signals. Microseismic activity, geodetic measurements of ground deformation, and updated probabilistic hazard calculations that collectively define what the USGS describes as a zone of ongoing moderate seismic activity with the potential for rare but catastrophic events. The USGS hazard curve for the New Madrid zone estimates a 10% probability of a magnitude 7.5 or greater earthquake occurring somewhere in the zone within the next 50 years. That is the same probability level that is used as a standard planning threshold in many building codes and engineering guidelines. It is not a remote possibility. It is a planning level probability. A magnitude 7.5 earthquake centered near New Madrid, Missouri, would produce modified Mercalli intensity 10 shaking, classified as very strong to violent, across portions of Missouri, Tennessee, Arkansas, and Kentucky simultaneously. At intensity 10, most masonry structures fail. Bridges over the Mississippi and Ohio rivers, the primary transportation links across the region and critical arteries for emergency response and economic activity, would sustain significant damage. The USGS has estimated that a scenario repeat of the 1811-1812 sequence would cause economic losses exceeding $300 billion. FEMA's independent modeling of the same scenario has produced loss estimates in the same order of magnitude. Those loss estimates include a critical variable that distinguishes the New Madrid scenario from virtually every other natural disaster scenario in the United States at comparable cost. The overwhelming majority of those losses would be uninsured. In California, the Northridge earthquake produced $25 billion in insured losses out of roughly $40 billion in total economic losses, about 60% insurance penetration. In the New Madrid zone, with earthquake insurance penetration at 1 to 3%, a $300 billion economic loss event would produce an estimated $5 to $10 billion in insured losses. The remaining $290 billion would fall on homeowners, businesses, state and local governments, and ultimately the federal government with no insurance mechanism to distribute or absorb the loss. That ratio is what drives the catastrophic risk concern at the federal level. FEMA and the Congressional Budget Office have both identified the New Madrid Seismic Zone as one of the scenarios most likely to overwhelm the federal disaster assistance system if an event occurs. Not because of the earthquake alone, but because of the financial vacuum beneath it. There are also signs of a slowly developing building stock improvement in portions of the New Madrid zone. The state of Tennessee adopted enhanced seismic provisions in its statewide building code in the early 2000s, requiring new construction in high-hazard counties to meet seismic design standards that older buildings do not. Memphis's Shelby County has conducted seismic retrofit assessments of public buildings, schools, firehouses, government offices, and has completed retrofit work on some of the highest priority structures. The University of Memphis Center for Earthquake Research and Information has produced detailed ground motion maps of the Memphis metropolitan area that have been used by the city's planning departments in reviewing new development proposals. This work is meaningful and it is real. The problem is not a complete absence of seismic awareness in the region. The problem is the scale of the existing vulnerable building stock. Hundreds of thousands of structures that predate seismic codes, built on soft ground, with no financial mechanism to accelerate their retrofit or replacement. Keep an eye on the movement toward a New Madrid equivalent of the California Earthquake Authority, too. Several academic and policy research centers, including the Mid-America Earthquake Center at the University of Illinois and the Multidisciplinary Center for Earthquake Engineering Research, have published frameworks for a regional earthquake insurance pool covering the New Madrid states. The technical architecture for such a pool has been designed. The actuarial models exist. What has not materialized is the political will and funding commitment necessary to capitalize it. That commitment may ultimately take the form of federal legislation, given the interstate nature of the hazard zone and the scale of the financial backstop that would be required. Here's what the science leaves us with, and we have to be precise about what it says and what it does not say. Is a major New Madrid earthquake imminent? Scientists do not have evidence supporting that conclusion. The New Madrid Seismic Zone is currently producing small to moderate earthquakes at a rate consistent with its historical background activity. Several hundred microearthquakes per year, with occasional felt events in the magnitude 2 to 3 range. Nothing in the current monitoring data indicates that a large event is about to occur. Scientists cannot predict major earthquakes with the precision that would be required to issue a meaningful warning for a specific fault at a specific future date. The 10% in 50 years probability is not a prediction. It is the geological record expressed as a probability distribution. What scientists are saying, clearly and without qualification, is that the 12 million people living above the New Madrid fault system are living above a fault system that has produced magnitude 8 earthquakes within the past 215 years, that has a measurable probability of doing so again within the next 50, and that the built environment they live in, older buildings, soft, ground, limited earthquake-resistant construction, and almost no financial backstop, is not prepared for that event when it comes. The insurance industry did not cause this problem, but its decision to price itself out of the New Madrid market is the most legible public signal that the problem exists. When the people who make their living calculating and pricing risk conclude that the risk is too large to insure affordably, that is information the rest of us should not ignore. If you live in Missouri, Arkansas, Tennessee, Kentucky, or Southern Illinois, there are 3 things you can do starting today. First, contact your homeowner's insurer and ask specifically whether your policy covers earthquake damage. Most standard homeowners policies do not. Find out definitively in writing. Second, ask your insurer what earthquake endorsements or riders are available and at what cost. Even a high deductible policy provides some protection that no policy does not. Third, ask your state legislators, specifically your state insurance commissioner's office, whether any legislative action on earthquake insurance access is being considered. The California Earthquake Authority was created because California homeowners and legislators understood that the private market alone would not solve the problem. The New Madrid states can make the same decision. Drop a comment and tell me what you found when you made that call. And let us go for 5,000 likes so this reaches the people in the zone who are still assuming their homeowner's policy covers them. It almost certainly does not. See you in the next one.